Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into a filing from Nektar Therapeutics, and trust me, it's not your typical bedtime story. We're talking about potentially diluting their stock, which might leave some investors feeling a little less than thrilled. So let's take a look at what's going on. Nektar Therapeutics, a biopharmaceutical company, just filed a Form 8K. This is basically a current report companies use to announce big news to investors. The key takeaway, they've made a deal that allows them to sell up to $75 million worth of their common stock. This all happened on March 28, 2025. That's the date Nektar officially entered into this agreement to sell more shares of their stock. So what exactly did Nektar do? They entered into what's called an equity distribution agreement. Think of it as a pact with two firms, Piper Sandler & Co. and BJIG LLC, who will act as their sales agents. Nektar can offer and sell shares of its common stock through these agents, up to a total of $75 million worth of stock onto the market. These shares will be sold under something called a registration statement. This is basically a document filed with the Securities and Exchange Commission, or SEC, to register the offering of these shares. It's like getting permission from the government to sell these securities to the public. This registration statement was filed on March 28, 2025. The way they're planning to sell these shares is through an at-the-market offering. This means they can sell the shares directly on the Nasdaq capital market or any other trading market for their stock. It's like selling your goods directly in the town square rather than through a middleman. Now here's the thing, Nektar isn't obligated to sell any shares, and Piper and BJIG aren't required to sell any specific amount either. It's all very flexible. They can stop or suspend the offering at any time, as long as they give notice to the other parties. It's like having the option to start or stop a project whenever you want. When Nektar wants to sell shares, Piper and BJIG will act as their sales agents. They'll use their best efforts to sell the shares based on Nektar's instructions. This includes any price limits, time constraints, or other conditions Nektar might set. It's like hiring a real estate agent to sell your house, but you get to tell them exactly how you want it done. For their services, Nektar will pay Piper and BJIG a commission. This fee is 3.0% of the gross sales price of any shares sold through them. So for every dollars, it's like paying a percentage of your sales to a salesperson. Nektar also agrees to protect Piper and BJIG from certain liabilities and to contribute to covering any losses they might incur. This is a pretty standard part of these kinds of agreements, ensuring everyone is protected. First, we have the equity distribution agreement itself. This is the actual legal document that outlines all the terms and conditions of the deal between Nektar, Piper, and BJIG. It's like the blueprint for the entire stock selling operation. Then there's the cover page interactive data file. This is a digital file that contains all the key information from the report in a format that computers can easily read and analyze. It's part of the SEC's effort to make financial data more accessible and transparent. Now let's step back and look at the bigger picture. So why is Nektar doing this? Well, companies often sell shares to raise money. This cash can be used for research and development, paying off debt or expanding their business. It's like taking out a loan, but instead of borrowing money, they're selling a piece of their company. However, there's a potential downside for existing shareholders. When a company issues more shares, it dilutes the value of the existing shares. Think of it like cutting a pizza into more slices. Each slice is smaller, even though the pizza itself hasn't changed. For example, Nektar may be trying to raise capital due to challenges with their drug pipeline or to cover ongoing operational costs as they restructure. Nektar's stock has had its ups and downs over the past few years. Investors have been watching closely to see if their pipeline of drugs will pay off. This stock offering could be seen as a way to buy them more time and resources to try and make that happen. The success of this offering will depend on market conditions, investor confidence, and Nektar's ability to effectively communicate its plans for the future. This type of announcement can influence share prices as existing investors might react to the dilution of their holdings and the implied need for funds. Tick now for my take on the company. Nektar is at a pivotal moment. This offering can give them the financial boost they need, but it also carries risks. If they can successfully use these funds to advance their drug development programs, it could pay off big time. If not, they might face more financial challenges down the road. One of the strengths of Nektar is their innovative technology. They've developed a unique platform for creating new medicines. However, drug development is a risky business. Clinical trials can fail, and regulatory approvals are never guaranteed. These are risks that Nektar and its investors have to be aware of. In conclusion, Nektar's stock offering is a strategic move with potential benefits and risks. It's a reflection of the company's current position and its plans for the future. Investors will be watching closely to see how Nektar uses these funds and whether they can deliver on their promises. Thanks for watching. If you found this analysis helpful, please like, comment and subscribe for more deep dives into the world of corporate finance. Let me know in the comments what company you would like me to decode next.